Good morning, good afternoon, good evening. You are watching the Paris Fintech Forum Communities video interview series. I'm Elliott Gotkine, and today I'm joined by the co-founder and CEO of Varo, Colin Walsh. Welcome.
Thank you, Elliott. It's great to be in this conversation with you today.
It's great to see you. And before we get cracking, we're going to first learn a little bit more about Varo. So, Colin, you're a neobank, but how does Varo differ from the Chimes and Revoluts of this world?
So I'd actually like to think of us more as a tech bank than a neobank. And I think one of the key differentiations is that Varo is a real bank. So we are a fully chartered OCC national bank. We are a direct member of the FDIC, and we went through a fairly rigorous process to become the first and still the only consumer fintech in the United States that has been fully licensed by the regulators. And that gives us some distinct advantages, particularly in the current economic situation that we find ourselves in. Our deposits are all sitting at the Federal Reserve, so it doesn't really get much safer than that. We manage our own risk management, we manage our own regulatory relationships, and we are building a very robust suite of products to help our customers solve very distinct pain points, and we'll talk a lot more about that, I'm sure. But it's definitely a good time right now to be operating as a bank that is protecting its customers' money and ensuring that they are safe and secure.
Right, I guess in that respect, it's a competitive advantage against other digital banks.
Absolutely.
Obviously, we've seen fintechs, neobanks, digital banks, growing incredibly fast, but not necessarily making much money. Are you able to put some numbers? I know you're obviously a privately held company, but can you give us a sense maybe of the kind of growth that Varo has been experiencing and any indications towards your path to profitability?
Sure. Since we became a chartered bank, we actually have grown our customer accounts quite rapidly. I think last year, when the market started to change, we started to recognize that sort of the grow at all cost strategy was probably not the most wise, given the fact that funding was contracting. The economic cycle seemed to be coming into fruition, where rising inflation, rising interest rates, and so we took a number of steps to slow down that growth and really focus on our best customers and being able to create a highly engaging experience that's solving real problems for our customers, whether it's around cash flow or access to credit or building savings habits, in a complete solution, which is driving a very high level of engagement with our customers, and to your point, helping us greatly improve our economics. So just in the last year, our unit economics saw a step change improvement as we sort of slowed down that sort of rapid growth and focused on finding those best customers that were going to not only use the core bank account, but actually all the other products and services that we provide. And so we have a very clear path to profitability. We don't disclose kind of exact timeframes, but certainly we're seeing some very good progress towards that.
Okay, and I think if I'm not mistaken, there was talk, maybe it wasn't necessarily from your mouth, but there was certainly talk about an IPO for Varo at some point. Realistically, the way that financial markets are right now, is there a sense that if this is going to happen, it's not going to be until 2024, 2025?
Yeah, I would say that it's not going to be in the next year or so, given the markets. And I think at this point, we've got a real focus on a core group of consumers that very much need what we're doing. We serve the sort of everyday hardworking American consumer that's living from paycheck to paycheck and values what we're doing, and as evident in our very high NPS scores, our high app ratings, and so as we think about the massive group of consumers that we can effectively serve, that our focus right now is just building out the product suite that does that, driving the economics in a way that creates a very sustainable long-term business, and then we'll think about becoming a public market company at the right point in time. I think given what we're seeing in the markets right now and the dynamics, that it would not be a time that I would be interested in going public.
Okay, so we've heard a bit about Varo. Let's now get to know Colin a little bit better. So Colin, unless I'm mistaken, you spent much of your career with storied institutions like American Express and Lloyds Bank in Britain. What possessed you to go it alone?
Yeah. So I think it was really the culmination of many years of having operated inside the existing incumbent world where I saw time and time again that the system worked really well for folks that had wealth, they had income, they could afford to get onto the housing ladder, they could afford to participate in the ownership economy, whether it's owning businesses or investing in the markets. But for those that were trying to just get by and might be working a couple of jobs, might be trying just starting out and trying to build up their credit, might be looking to start to build greater financial resiliency and start saving. The incumbent institutions were just not serving them well. And in the face of rising wealth and income inequality, it felt like something had to be done about this. And could you create a platform and a digital first banking experience that could effectively serve all consumers? And that was really the inspiration for Varo, and being able to use technology to bring down the costs and to think about things like digital identity to manage fraud, being able to build sophisticated tools to effectively underwrite credit, and do things that the incumbent institutions just simply are not able to do. And in the process, be able to reach a very wide audience of consumers and make a difference from a wealth equity perspective. And so that's really what inspired me and my team to create Varo and to build something that has a really unique role in the banking industry. And so I feel like we're still early days on that journey, but certainly as we're getting more and more traction, it's becoming evident that this is something that is very much needed in the system.
And what for you is the best and worst thing about being an entrepreneur?
When you're inside a big company, you have access to resources, you have access to brand. When the early days, especially when you want to set up a third-party relationship, people line up at your door. When you're starting, certainly when you're starting out, you're starting from nothing. I mean, you're starting from scratch. And so, fortunately, because I had all those years of experience working at some of the companies you mentioned, American Express, Lloyds, Wells Fargo, I knew a lot of folks, and so was able to connect some of the relationships that I'd had previously into the new world, was able to credibly talk with investors and regulators because I had that base of institutional experience, but it's harder when you're on your own. And as an entrepreneur, you literally are building from the ground up. And so Varo has been built from scratch and just, an idea and a lot of motivation and inspiration to make the world a better place and being able to bring people along on that journey too, because, certainly in those early years, and even as we're driving towards profitability, it's just different. The compensation structures are different. The sort of motivations are different, and how the sense of urgency is very different. Because as you're starting a company, it's not like in a big company where you could just sort of wait around and take months to make a decision. Like things have to happen, and they have to happen quickly. And so being able to ingrain that into the culture is also very different. And the types of folks that want to be on that journey are going to be different. So it's been a ton of learning for me, and certainly, it feels like a whole nother world when I was inside those big corporations. And once you've actually built something from the ground up, I don't think there's any going back either.
And I suppose it's good that automatically there's an adult in the room when someone with your experience is the founder, as opposed to someone that's kind of doing it as their first foray into the world of work. But outside of Varo, Colin, I mean, you personally, what do you get up to? I'm sure it's all consuming and you don't have much time for many things, but do you climb mountains at the weekend? Are you kayaking? What are you getting up to?
Yeah, I do a lot of things. So I'm still I'm on the international board of the British Film Institute, and so still very involved in film and working with artists and filmmakers and learning more about how to the BFI is one of the world's renowned institutions in terms of restoration and it has a massive archive a film archive. So things like that I have a lot of passion for. Yeah, definitely try to stay, get as much outdoor time as possible. Have two dogs, and so they keep me busy on the weekends. Big dogs, so getting out and about. So definitely try to keep a diverse set of interests outside of work. But as you mentioned, when you're building something and something that has the potential to really transform an industry, it can be fairly all-consuming. But it is really important to find that healthy balance and not always be working. So although people who work for me might argue otherwise.
Absolutely. Okay, so look, a key part of this interview is to get your take on the future of finance. But first, we're going to take a very quick break, after which we're going to continue our conversation with Varo co-founder and CEO, Colin Walsh. Welcome back, and don't forget, if you're not already a full member of our community, everything you need to join can be found at www.parisfintechforum.com. Okay, now Colin, let's talk about the future of finance. Okay, now, since you're a bank, I guess we have to at least mention a little bit about what's happened earlier this year in the banking world, namely the collapse of Silicon Valley Bank and, of course, the rescue of Credit Suisse. You've been at big financial institutions before. I think, unless I'm mistaken, you were even at Lloyd's when the global financial crisis took place. Were you shocked by how quick everything happened, at the scale of things when you heard that Silicon Valley Bank was collapsed, and then again after that Credit Suisse being taken over by UBS in a kind of forced marriage?
Sadly, not. So I feel that having been to this movie before and seen how things quickly unfolded back in 2008, and when I was at Lloyd's, I was running the cards and payments businesses, and then I got a call from my boss saying, we've just brokered a deal with the Prime Minister to take over HBOS, and had to step out of my day job to actually run the integration of the two retail banks, and then deal with a number of different issues as I was focusing on different sides of the business at that time. And so when things started to unfold in recent weeks, unfortunately, it felt like there was a little bit of pattern recognition. We made some very quick steps on our end to make sure that all of our funds were sitting at the Fed so that our consumers' deposits would be 100% safe. And we also, I think, from experience, have not made some of the bets that maybe others have made. We did see in kind of the COVID era, there was a lot of stimulus money that flowed into the system. On the back of that, you saw a number of IPOs and SPACs and big funding raises, and so there was a lot of cash in the system. And so in pursuit of getting more yield after a very long period of low interest rates, some banks took some duration risk, and unfortunately, as the Fed started to quickly, and other central banks started to quickly raise rates, there were big losses that were starting to grow in those portfolios, and suddenly those got exposed as deposits were moving out. And so this is what sort of created this situation, certainly in the sort of Silicon Valley, and then there was other issues with crypto exposures and so on and so forth. And I think that, one of the things from just an experiential perspective is not taking those risky bets, particularly as we're building a business that, is built on a foundation of trust. And at the end of the day, what consumers, particularly right now, care most about is safety and protection. And so as we think about the future of banking, and where things are going to go, I mean, cycles do tend to repeat themselves, unfortunately, despite the best efforts on the part of the regulators and others in the industry. But I do think that there's going to be more consolidation, and I think there's going to be consolidation in the neobank space. I think there's going to be consolidation among some of the smaller banks that may not be able to stand on their own 2 feet. And unfortunately, there will be more of a flight towards the larger institutions, or institutions like ourselves that don't have some of these inherent exposures, aren't operating in a sponsor bank model where there may not be real clarity in terms of what are the underlying risk exposures at those sponsor banks. And so consumers will probably there'll be a bit of a flight to safety for a while. I do feel that markets will normalize, and right at the moment, there's not a lot of discretionary investment, so you're probably seeing a little bit less on some of the proliferation of new businesses and sort of grow at all costs that we talked about earlier. But I think there's going to be a little bit of like hunkering down and grinding it out and doing the right things. But I do think those that have sort of prudent and effective risk management approaches are going to be rewarded at the end of the day, because it is built on trust and safety. And those that can sort of weather through this period of time will be the ultimate beneficiaries. But I do think you'll see more consolidation, and you'll see fewer players that are going to probably have even heightened sensitivity and focus on effectiveness of the risk management within their institutions. And the regulators as well are going to pay a lot more attention to certain things that perhaps were not really well understood as things were just unfolding quickly in the market dynamics. I mean, no one anticipated COVID. Nobody anticipated sort of what would happen after COVID. I think we probably could have anticipated what could happen when you start to rapidly raise interest rates. But there is a confluence of events that have occurred here that will find their own level, and they'll normalize. But I think the industry landscape could look quite different by the time we get to the other side.
All right, and as you say, just because a scenario like a pandemic is unprecedented, it doesn't mean that the impact of, or the impact on, or rising interest rates or higher inflation or dislocation in bond markets doesn't mean that those actual things are unprecedented. So it's important, obviously, to get a sense of what those things.
Where there was some pattern recognition, though, from my perspective at least, was the speed at which all of this started to unfold. And I was like, oh, here we go again, because, right on the back of Lehman's, and then there was just one after the other, and, sort of to see that this was, and I think the fact that the system did work, certainly in the US, as intended by the regulators stepping in and very quickly being able to bring a little bit of security and stability by doing the things that they did, was very important. And I think that was an important lesson learned from the last time, is just having decisive action that sort of rests people's nerves a little bit, so that you didn't see this sort of huge deposit flight out of some of these other institutions.
Right. I have to say, Colin, you've kind of answered a lot of my subsequent questions in that earlier answer. But one thing, I mean, you talked about the potential for consolidation among digital banks. I'm wondering if as a signal to potential customers, we might see more digital banks going down the route that you've taken, which is to get your banking charter so that, people know that they can be more confident that their money is safe, even if, as we've seen so far, although it's not explicit, it seems unlikely the Fed's going to let anyone lose any money in terms of their bank deposits, but at the very least, having the banking charter helps give people more confidence. So do you think more digital banks will follow your example?
I think they'll want to. I think there's a little bit of, there's the other stakeholder involved here are the regulators themselves. And so I think they're going to be cautious around how many, of these players they let into the system. It's a fairly rigorous process of getting through that regulatory approval and being able to demonstrate the viability of the model, the level of knowledge of the banking system, both in terms of management as well as board, sort of effectiveness of risk management, the decisions that are being made in terms of the types of technologies and tools that are being used. And so all of that will, but I do think there'll be a heightened level of interest in terms of pursuing the chartering route, because I do feel it's and ultimately history will be the judge here, but I do feel it's the most long-term viable, sustainable model, and it affords more levers to be able to navigate through a situation like this, and being able to just provide a much deeper set of experiences and solutions for consumers and businesses as well.
Of course, over the past, I guess, year or so, we've seen financial markets being incredibly volatile. We've seen plunging valuations, not just in fintechs, but in tech companies in general, whether publicly traded or privately held. Do you think after this, we've seen Silicon Valley Bank, which of course was, integrally involved with tech companies as well, so that might have been another kind of shock to confidence. Do you think that maybe now this is the bottom, that valuations have bottomed out and we should start to see fewer down rounds for tech companies and indeed fintechs?
Well, I think there's always going to be money for good companies, and so I think that it's a matter of do companies have a sustainable business model? Do they have, if they're not already profitable, do they have a clear path to profitability? I do feel that there's still potentially more volatility ahead. What we haven't seen, fortunately, up until this point, is widespread unemployment. So the employment markets have held. But if we do start to see the impact of rising rates and now some of the dislocation that's occurring in some of the banking sectors, does that ultimately then result in less lending, less business lending? Then you start to see contraction in the business sector, and then a more widespread unemployment, and then that will bring in credit losses that many of the institutions that have been lending and potentially lending through a very long, fairly benign cycle. Once unemployment starts to tick up, you could start to see a wave of credit exposure that it would be the kind of the next shoe to fall. So I don't know that we're completely out of the woods. So as much as I'd like to think that, okay, we've hit bottom and now things are going to stabilize, I think there's probably a few more quarters of uncertainty as some of the actions of the central bank take effect, and see what happens in terms of the broader economic situation in some of the larger economies. And then obviously there's geopolitical risk and climate risk and other things out there. But I think just focusing specifically on the more macroeconomic pieces, I think we'll have to see how this plays out. And so I would say 2023 is going to be another year of some degree of uncertainty until we start to kind of get to a new normal.
Okay, so Colin, it's time now for our round of rapid fire questions. Are you ready?
I'm ready.
Okay, so I've got 90 seconds on the clock. Just one word answers is all I'm after, and I'm going to start the clock in just a moment. Okay, away we go. What fintech segment has the biggest potential over the next 5 years?
Digital banking.
What is the biggest pain point in your everyday financial life you'd like to see resolved?
Good question.
Okay, we'll move on. Do you think we're at the beginning, middle, or end of the fintech wave?
Middle.
Do you have a metaverse strategy?
Not now.
Do you think regulators in the US and the European Union have adapted enough to handle all the new possibilities and behaviors we're seeing in the financial industry?
They're learning to.
How would you describe non-fungible tokens, NFTs? A scam, B, an interesting concept, or C, part of the future that we really don't want to miss out on?
B, interesting concept.
Have you personally ever invested in crypto?
No.
Are physical points of sales part of the future of finance?
Yes.
On a scale of 1 to 10, 1 being the least likely, 10 being the most likely, how do you rate the following things of happening in the next 10 years? That one of the neobanks, digital banks, will be as profitable as a top-tier legacy bank.
7 or 8.
CBDC, central bank digital currencies, will become a mainstream reality in the US and Europe.
8.
you'll be able to open a crypto account at a top-tier bank?
10.
Okay. As you heard, the bell has sounded, so we're out of time for a rapid-fire round of questions and for our conversation. So I am afraid that's all we have time for, but I really want to thank you, Varo co-founder and CEO Colin Walsh, for taking the time to speak with me today. Thank you.
Thank you, Elliott. It's been a pleasure.
And for everyone watching, we will be back again next week with another big name from the world of finance and technology. We do hope you'll be able to join us again then. In the meantime, don't forget to subscribe to the Paris Fintech Forum YouTube channel and to follow us on Twitter at Paris Fin Forum. That's all for now. Hope to see you next time. Bye-bye.